and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, the RBI has hiked rates yet again, and that's by 50 basis points. And this has now taken the benchmark rate to 3-year high of 5.9%. That's the highest level since April 2019. Now, joining in to really help us decode as to what this really means for the common man, our wallets. With me, I have Dilshad Billimoria, MD and Principal Officer, Dilshad Consultants, and Roongta, renowned financial advisor. Welcome to both of you, and thank you so much for taking the time out for this discussion. Well, let me start with the first thoughts from both of you. Dilshad, let me start this discussion with you. Is it bad news for borrowers now?
Well, I think banks will be cautious passing on the rates, because the festive season is round the corner. But definitely, when there's a rate hike, and this has been now it's gone up to 5.9%, and this is the fourth rate hike effective May 22. But I pass on to the home loan borrowers, even though there has been like a 190 basis point right from May to now, I think that the actual rate hike for home loan borrowers is just about 80 basis points.
Right.
And therefore, the extent of transfer of rate increase is not going to be as high.
Okay.
And banks will, I think, be a little cautious before they go in for an immediate, kind of pass on to the customers. Yeah.
Okay, Mr. Roongta, your thoughts? Does it mean that borrowers have to live much longer in debt?
Okay, that's a pretty grim way of describing that. But the impact is you can differentiate it between existing borrowers and new borrowers.
Yes.
So I think one of the things that has happened since November or October of 2019 is that banks have been forced to shift to market-linked, interest rates, and most banks have chosen to link it to the repo. And therefore, as far as existing borrowers are concerned, to the extent it is linked to repo, it's already been passed on. To the extent that the banks have linked it to other than repo, it typically tends to be shorter term liquid, like a T-bill, 30-day T-bill, etc. That's probably been already built in. Okay, so I think existing borrowers are living through the increase and will continue to live through the increase. For new borrowers who are now going to take a home loan, I think Dilshad is absolutely right. There will be some muting of the pass-through. And I think we will not see complete increase to the extent, and there might be a delay in the increase, at least for new borrowers. So I think that is what we are likely to see.
Right. But just to clarify to everybody who's a borrower out there, some have home loans, some have auto loans, some are, personal loan borrowers. Do all of them get impacted? What about gold loans and education loans? Just to give that clarity to the viewers. Harsh.
So car loan and personal loan tend to be fixed rate in most cases, right? And fixed rate loans are obviously not affected. They tend to be shorter duration. So they may not be affected at all, but there are definitely, if you look at, say, SBI, they have both. I think they have fixed rate car loans as well as floating rate car loans. To the extent it is floating, it will be affected because it's linked to the repo. If it is fixed, it will not be affected. Personal loans almost always tend to be fixed rate. So the existing borrowers are not affected. New borrowers obviously will probably get it at a higher rate.
Sure. Okay. Dilshad, just to take it away from the point that you were making in your earlier answer, say, if not to that extent of, say, 1.9%, just a broad idea of how much more will I have to shell out on an EMI every month is if, say, I have a home loan of, say, 50 lakh rupees for 20 years, how much will, that raise be now for me?
We'll need to do the calculation, but very, very briefly, I think it won't be more than between about 950 to 1,500 more per month in terms of the EMI. And that's about, on a 50 lakh at 8.5% for 20 years.
Okay, so a 12,000 rupees or 11,000 rupees per year basis, I will have to shell out more. So gives that clarity to all the viewers who are also borrowers at this point in time to get an idea of how much will they have to shell out. But eventually what we always see is whenever the RBI hikes these rates, banks immediately tend to increase the tenure of the loan that you borrow it for, rather than giving you that automatic option of increasing that EMI. But I want to understand from you, Mr. Roongta, which of the two is the worst one? Because either ways, I'm going to pay out more, but which is the worst and which one should you go for?
I mean, there is no one answer to that. And this is, I mean, in the olden days, basically, because it was logistically difficult to sort of increase or change the EMI amount, and, the instructions were very specific. Nowadays, the banks take a debit instruction for a slightly higher amount than yours, so then what is due. So if they want, they can charge more. But typically, it's administratively much cleaner for the banks to increase the tenure. You can always go back and get your tenure kept the same and increase the EMI. Also, please remember, it also does not disturb your budget, because remember, rates have gone up, rates will go down. And if your EMI has remained constant, in the background, your tenure is going up and down. And hopefully, as you go through the cycle, in the end, you may not have to live as long as you thought you would have to live to pay off the loan.
Okay, understood that. So, Dilshad, do you agree to that? And if not, then what are the other options that one can avail to save oneself from the high cost of borrowing now?
Yeah, I think definitely sometimes banks by default increase the tenure, and that's a very hurtful point for the investor or the borrower. So I think it's the onus of the borrower to inform the bank that to not increase the tenure, but retain the same tenure, increase the EMI if they are able to afford that. So that's a very important point also to be considered. But definitely, as Harsh said, whenever something goes up, it also falls down.
Yeah.
Right? There is going to be a cycle where at some point, especially if you're in the external benchmark rate or the floating rate, you are going to benefit, even in a declining interest rate scenario over a longer tenure. But I think it's important for the borrower to try and ensure that the bank does not increase the tenure, because that's where the maximum earning of interest happens for them.
That's true. That's very true. Also, I've heard about this option of, say, prepaying of loans. Mr. Roongta, would you advise that to people, prepaying of loans at all?
So, it's very difficult to give generalized advice, but if you were to do rules of thumbs, and, the one rule of thumb is that if you can afford to pay off the loan, pay it off. Okay. I mean, people tend to do a lot of calculations and, I'll get a tax deduction, etc. Now, tax deduction only reduces the cost of the loan. You're still paying. Instead of paying 9%, because you're getting a tax deduction, the cost may come to 6.5%, but you're still paying 6.5%. I can't see too many options where risk-free you can generate 6.5%. So if you have the cash, it's better to pay it off. And anyways, remember that tax deduction is nowadays limited to a maximum loss of 2 lakhs.
Okay? Right.
So in most cases, and I have to have that caveat, in most cases, I think you should prepay the loan rather than, invest it somewhere. I have never been a believer of this opportunity cost of investment being higher, and therefore don't prepay, simply because, yes, investments could give more, but then you're taking a risk to be able to get that higher return from an investment.
Point noted. Dilshad, is there any penalty on these prepaying of loans to any banks if somebody has taken it from even NBFCs? What's the option there?
Right. So I think most of the banks do not provide for a penalty when you do, I think, 2 prepayments a year. Most of the banks have different rules across the banks, but up to 2 or even 3 prepayments, there should be no penalty at all. And in
Mm-hmm.
fact, some banks say that when you just take a loan up to the first 6 months to 12 months, if you do any
Yeah.
prepayment, the penalty is likely to be higher. For what reason, we don't know. But yeah, that is something that borrowers must consider while making the prepayments.
Okay, Mr. Roongta, one more thing that all the viewers who may be potential borrowers may be now in a doubt that whether this is the time for me to now go ahead and take that loan, because any which ways I'm going to be paying more for it, especially for those who are home buyers who may now say that, okay, I will wait for another 5 years or 10 years and then think of buying. What would you really advise to them now?
So my point is, loans is a means to an end, right? You take a home loan because you want to buy a home. You
Yeah.
take a car loan because you want to buy a car. You take a personal loan because it fulfills a certain purpose.
Hmm.
I think independent of the interest rate, because as we just said, interest rates are a cycle. They will keep going up and down. Sure, when interest rate go up, the amount of loan you are eligible for reduces. And to that much extent, it might impact your home buying decision. But otherwise, there is the right time to take a home loan is when you are buying a home. So I think the real question to ask is this the right time to buy your home? And I think the answer to that is dependent on number of factors, only one of which is the interest rate.
Right.
Interest rate is going to fluctuate.
Yeah, absolutely. But Dilshad, would you say that perhaps people will say that, okay, I'll keep on renting my place, maybe is that a better idea right now between buying a home and renting out? What would you advise there?
So I would agree with Harsh that buying or renting is more a personal or an emotional or a financial decision also.
Yeah,
Interest rates play a very minor role when it comes to deciding whether you'd like to buy the house, or rent it out. And when we talk about these raise in interest rates, it's not going to be a very drastic impact in terms of increased payout in EMI ways for the borrower. So I think the main decision, like Harsh said, is very important. That what stage are you in your life today? Do you need to, is this your first home? Is this your second home? What is the purpose of it? And what makes financial, emotional sense as well? So I think these are the factors that one needs to consider when they're considering to buy or rent.
Okay, so far we've discussed all the pain, but let's also discuss the brighter side as well. Is there at all some good news for someone, say, who are depositors saving money in banks? Do they get to enjoy higher rates of interest in this rising interest rate scenario? And is it the right time to now begin your investing in FDs? What would you say, Mr. Roongta?
So, obviously, when interest rates are high, you will get more, but you must remember that the more is coming because inflation is high. Effectively, net of inflation and net of tax, you are getting negative returns, right? Even in senior citizen savings schemes, it is now at say 7.6. Okay.
Yeah.
Please remember it's 7.6 minus tax, right? So if you minus the tax, if the person is having taxable income, then depending on his tax rate or her tax rate, the interest would be 6%. That's lower, 5.5%, 6%. And that's lower than the inflation, which is currently running at 7.1%. So, you still are in negative interest rate territory. And again, as I can say, although because most depositors tend to prefer fixed rates, we still don't have a market where people are, comfortable depositing money with floating rate. The only instrument that's popular with floating rate is the RBI floating rate bonds. Yeah. And if you will look very carefully in this rate changes that they have announced, you will see that they have not changed the national savings certificate rates. And the reason for that is the RBI floating rate bonds are linked to NSE rates. Okay, so they don't
That's
need to increase that rate.
that's
So I think, sure, I mean, it's a good time, but I think people should examine whether fixed deposits are the right way to take fixed income exposure. There are other more friendlier, equally equally less risk, but definitely far more tax friendly options that are now
Give me an
available.
example. Give me an example.
So just let us pick up something like what is called the Bharat Bond 2023. Okay.
Okay.
Now, Bharat Bond 2023 basically is investing in, I think, 15 or 16 bonds of PSUs, all rated AAA.
Okay.
And all of them will be maturing in April of 2023. Now,
Hmm.
the chance that any of these AAA rated public sector units will default before April 2023 is low. It's not zero, it's low, right? It is today giving you an yield of 6 point, I don't know, 6.7. It varies from a day to day.
Okay.
It's very close to 7. Of course, there the tax-friendly nature does not kick in, but there is
Yeah.
no TDS, for example. But just pick
Mhm.
up, say, 2026, Bharat Bond, similarly 2026. Now, that's after 3 years. Okay. So, the tax is payable at maturity. Yield
Sure.
gets locked in. You may see your NAV vary a little bit up and down, but if you hold on till maturity, which is what you do with a fixed deposit,
Very,
you
very true.
will get the close to 7% yield. And
Mm-hmm.
because you pay much lower tax, you will end up with a net yield of 6.5, 6.6.
Okay.
Whereas in a fixed deposit, even if it was earning the same rate, you would
Mm-hmm.
end up being at 6% or 5.75%.
What would be your pick? I mean, we are amid this festive season. Most of the asset classes are giving us negative returns. What should you really go for at this point?
Yeah. So first, to answer the question on, whether the depositors would get the benefit pass on.
Yeah.
First of all, I don't think we are at the end of the rate hike cycle. There might be a slight increase. It might go to about 6 to 6.15, 6.2 by early next year.
Okay. Okay.
And second is, not every time there is a hike, it has been passed on to the depositors, right? So we've seen that, like Harsh pointed out, in the floating rate bond, it has not increased at all, beyond 7.15, despite the 4 rate hikes that have happened in the past. However, there have been some corporate deposits like, the Mahindra Finance or Bajaj, etc., which have, increased their deposit rates, but not with every rate hike that has happened again. So just like, in terms of the banks not passing on every rate hike when it comes to the EMI, similarly, the deposit rates are not going to be increasing at every instance, right? So it might translate to a smaller percentage. But definitely, I think, when it comes to investments, and there are better tax, advantage options when it comes to savings, and Harsh has already pointed that out. And sorry, what was your question on the
So which of the asset classes would you prefer? Would it be gold or equities? What would
Okay.
you go for in this
So-
festive season?
So I think that is, it's I would say, independent of the festive season. Although people tend to move towards gold, but at the end of the day, if you're able to ensure that you have negatively correlated asset classes as part of your portfolio, you're going to always be better off when one asset class does not perform well. And that is the whole purpose of asset allocation, right? That is why people need to diversify into various asset classes. And definitely gold, for to some extent, is a negatively correlated asset class, and therefore having 5 to 10% of one's allocation to gold is important. But equally important is equities, and today, when the markets are quite volatile and likely to remain so because of the environment, in the US, China, and other world markets, I think, adding at every instance whenever there is a fall and building the portfolio systematically is one of the best ways of long-term wealth creation.
Okay, understood that. Well, on that note, thank you so much, Mr. Roongta, and thank you so much, Dilshad, for being with us on the show, decoding it for all our viewers, what this hike means for us, how to really deal with it, what's the best way of saving this added on cost, and where are the best options available for us to invest in this current volatile market. Thank you so much. It's been a pleasure.
Thank you, Sakshi. Thanks for having us.
If you like the video, do like, comment, share and subscribe.